Welcome to this episode of the Bear Ventures podcast, where we open the book on venture capital and give you a seat at the table. I'm joined today by Rob Hilmer, founder and general partner of Goanna Capital, where they invest in growth stage companies and implement a unique mix of primaries and secondaries. Rob, it's great to have you on today.
Good to be here, mate.
Yeah, I'm happy we were able to do this. I know we caught up a few weeks back on what you're building over at Goanna, and you've launched a fund too and have had great success so far. So quickly, just, I like to usually start with an intro of a little bit about the fund and yourself, and we can go from there.
Yeah, absolutely. So we're raising our second fund now. As you mentioned, we focus on growth stage, predominantly US technology companies. So we focus on Series C companies all the way to true pre IPO opportunities. So to your point, one aspect of our model that's particularly unique in the ecosystem is our focus on not just primary or just secondary, but combining the best of both worlds. And obviously later on, we can talk more about what each of them are, the pros and cons associated with each deal sourcing channel, but really bringing those together. The second big difference for us is our co-investment program. We think co-investments are very important for investors in funds, not only because the fee level on a blended basis is lower and therefore hopefully higher expected returns, but it gives investors more discretion with their capital across different companies, sectors, etc. So we partner with our investors on the co-invest program, and that's very important to us. So that's where we are, and it's good to be here.
No, I appreciate that. And those are two great points that I do definitely want to touch on. And before we even get to that, a few of the folks listening they're currently at funds or thinking about raising funds or in fund one. You have been through the trenches of fund one successfully, and you've launched a fund two, and you've got great momentum behind you. So I'd love to hear just briefly, your experience raising a fund one, what kind of pushed you to do that, a little bit about your experiences and some more stories of how that really played out.
Yeah, no real horror stories, which I think is potentially unique. I was formerly at Co2 Management, which is an amazing, incredible founder-led firm. And so I think it helped me for a range of reasons. Most notably, I would say from a process perspective, by being there, I saw a number of unique things, most of which being around the importance of process with regards to building the firm, investing, just organizational structure and record keeping. That focus on process, I think, is lost with many funds because there's an emphasis put on diligence on a particular investment opportunity. Mm-hmm. But when you're building out a firm and doing diligence, I think the processes that you run in terms of record keeping, meeting notes, how you conduct meetings, et cetera, I think it's particularly important. And so from the first day of fund one to now, in let's say 6 to 8 weeks, wrapping up fund two as a raise, for me, the most important thing revolves around process. And everything needs to follow a consistent process. And I do believe that's been the underpinning that has allowed me to raise a first fund, do well with that deployment, and then hopefully go on and raise a strong second fund.
Yeah, no, it's a good point. And, I know there's more ways than ever to launch a fund, whether it's different structures on Angel's List or, how much easier it's gotten to, kind of get the right folks behind you to outsource some of the work and get things started. Or there's folks that just, will run SPVs, but, to your point of to really reach scale and build what it is you've done at Goanna, that's a very important point. So I appreciate you sharing that. And so kind of jumping into the fund, you mentioned primaries and secondaries. So before we even jump into the why, for those that might not be familiar, could you just quickly just go over what that really means?
Yeah, absolutely. So a primary round is what you read about in the press, and that is a company will raise a fresh round of preferred equity that will sit on top of prior rounds. as a capital infusion to go and grow the business. That's the simple story. You're putting money on the company's balance sheet. We do that. We also do secondary. A secondary is when you're buying shares from an existing stockholder in the company. In other words, you're not putting money on the company's balance sheet. You're giving liquidity to an existing stockholder of the company. Do you want me to get into why each are interesting?
Yeah, and it kind of leads into my next question precisely. So, it's a good point on, secondaries are a great way to build up positions and companies are excited about, even if there's not a round at the moment. And it's something that you do, quite actively and heavily at Goanna. So what was the reasoning behind making it such a big part of your strategy?
Yeah, I think so. I always try to do things that are uncompetitive. That's important to me. And secondaries are not a well understood market. In other words, when you think about the incentive of a GP, it's typically to raise as much money as possible. So if the path of least resistance for the investors who are investing in the best companies is to have the most amount of capital, they then want to have the most amount of capital for the least number of people at the firm. So said another way, what they'll end up doing is seeking opportunities that are predictable, where they can deploy capital at scale. That's what they're trying to do.
Mm-hmm.
And that lends itself to primary investing. When a company is raising a primary round, it's essentially like an auction with a I would say, publicized process. Publicized meaning sufficient numbers of participants understand the process. It's very clear, transparent, etc. So that's a competitive situation. An uncompetitive situation might be, for example, you're talking with an angel investor who says, I really want liquidity. I want to sell 20% of my stake. I need to sell in the next 3 weeks. And I want it to fund my next GP commitment or a house or whatever it might be. And I'd like to sell to someone who the founder of the company would like to have on the cap table. That is an uncompetitive situation. So with an uncompetitive situation, typically you won't be, by definition, bidding against other participants. And therefore, across the board and over time, hopefully the prices you pay for the same assets is superior. And therefore your forward returns are also superior. So for that reason, secondaries can be particularly interesting. I would say within the market itself, it's often marred by unreliable investors who a founder may not want on their cap table.
Mm-hmm.
And so the niche we fit is we approach companies first. We always start with the company. And we say, look, you've got this issue. You've got this problem. And that is you're sufficiently large now and you're sufficiently aged that there's a lot of investors, there's a lot of former employees in the company. They've held stock for a long time. They want liquidity. If you don't get ahead of it or have a clear process, they will go to the open market, they'll go to brokers, et cetera, and they'll wind up doing deals with investors who you don't want on your cap table. So you don't know who's selling, when, how much, at what price, who to. You have no idea what's going on. So let's get ahead of that and just allow me to go out and buy the stock. And we'll agree on a set of transaction documents, et cetera, price, timeline, process, et cetera, and we'll clean up that market. And so there's different ways to do it where you can do secondaries in the form of a tender with the company, where the company facilitates a broader tender. You can do one-off transactions with management. You can do transactions with former employees, and that can be combined with a primary round. So there's all these different ways to be a secondary investor now. But I think what's most important is if you're starting with the company, you are a primary investor, but you're a primary investor who solves a problem. So the reason I did this was I needed to solve a problem. Everyone in business, whether you're an investor, an entrepreneur, whatever, you are in the business of solving problems. That's what we all do. We solve other people's problems. So when I thought about Goanna, I thought, what are the problems out there? And we'll ignore the LPs, the investors in the fund for a moment. The problem for the founder, the CFO, the GC of the company is what I just ran through. They don't know who's selling and buying the stock. So I said, well, hang on. If I have relationships with all these people, I can tell them the story and what I'm going to go and do, and that should solve their problem because they want me to buy the stock. So I'll clean up the market for them. So I've solved that problem for them. So that addresses the first aspect of what makes Goanna different, the primary-secondary split. The second aspect that makes Goanna different, which was the co-investment program that I mentioned, that solves a problem of investors. And we can talk more about why investors want co-investments, et cetera. But really, for me, it was that two-pronged attack. And that's why I built the business, where I said, on one hand, I've got a problem that companies want solved. And on the other, I've got a problem that investors want solved. And if I solve those two things, I can sit in the middle and hopefully pick some good companies and invest at some good prices and generate some abnormally high returns.
Mm-hmm. And I think what you mentioned around, founder approved sale of secondary shares is really the key there. And, earlier on and, or not even earlier, but a few years ago, you'd even see some very messy situations where, everybody was running around trying to liquidate shares, whether it was an employee or an early stage investor, and the founder didn't always have knowledge of what was going on and the scale of it really. And so to have it aggregated is really exciting. And so, have you seen this play out, past that transaction into, for example, access to, more primaries for next rounds? Are you seeing other founders come to you
for sure.
same thing in their companies?
For sure. So it helps me get into primaries because I basically just say, look, so if I'm not in a primary already, but I'm chatting with the founder, I'll say, listen, just let me buy a little secondary. Either maybe someone who wants liquidity, maybe I buy from you. If someone approaches me to sell just in the open market, just let me buy a little liquidity. Buy a little secondary, and then let me on the cap table. Alternatively, if there's a primary ongoing, I'll say to them, listen, I'd love to be included in this round, and you should include me even though it's oversubscribed, because by having me on the cap table, I'll then go clean up the market for you. And I view myself as a bit of a bodyguard for the cap table, if you will, because there's no one else out there protecting it, because the company can't protect it on their own. So when they let me into the primary, I say, the way I'll pay you back is by being the bodyguard out in the secondary market.
Mm-hmm. Yeah, the true keeper of the realm. But no, it's certainly right. An interesting place and an important role. And thinking about, you've got this unique mix of primaries and secondaries. Have you seen a big difference between, for the most part, where you're getting in valuation wise on, these secondary rounds versus kind of where things play out in the primaries? And then more broadly, love to hear your thoughts on, what are valuations looking like generally in the growth stage? It's kind of a place where everyone's looking to jump in, and you've got, the pre-IPO folks coming a bit earlier and the early stage folks coming out with opportunity funds. How do you kind of play that tug of war?
Yes, in life, there's always a mismatch, and you see some equalizing variable to stabilize. The issue that we all have to grapple with is funds have gone and raised a lot of money the last 2 years, and there's a finite number of high quality companies, and the money has to go somewhere. These mega funds can't just decide not to deploy for 6 months because they think prices are high. The money goes out the door. And so I think that it's very important for earlier funds in their earlier vintages to be particularly mindful of this dynamic, because it can change. And it doesn't take much to change. So if you're Tiger or Coatue or whoever it might be of this nature, you can probably get away with, a fund that doesn't necessarily perform that well. If you're an earlier vintage manager like me, you have to be very mindful of it. And that's another reason I'm particularly focused on secondaries. because often the prices are truly better. And that's a result of the uncompetitive nature of the market. And so secondary can be a way to insulate yourself in that you might be buying, let's say, 30 to 40% cheaper than where the primary is going to come in, let's say, 3 to 6 months. I've done that many times. So you create a margin of safety there. So it is a challenge. I would say, as I look forward, I'll be investing Fund 2 over the next 24 months. I think that next year, the macro environment will dictate things a lot more than this year. And I do think there'll be more volatility. So all private companies seem to have just gone up and to the right. Whereas if you look at the macro or other markets, there was a lot of movement under the surface in the public equity spectrum that didn't transcend into privates, in that everything kind of went up. So I think next year there'll be a bit more movement on the private side in terms of business model, stage, how much cash do you burn? How efficient are you? How are you growing 50% or 110%? I think there's going to be a little more dispersion within companies, but also I think the macro will cause a little more volatility. So when that's happening, the secondary market is where you can really do some great investing, because I think the secondary market is where the volatility really shines through brightest. So look, I'm pretty excited about next year. I hope there's more volatility. I don't think the general primary investors would say that, because they don't pick up as much return from that the way I do. So you could think of me as being a little bit long vol versus those guys. So I hope to see a bit more of that. Yeah.
Yeah, you're definitely the first to say that, and I completely see why.
You're not going to hear a typical growth equity investor come in and say, I hope next year is really volatile, and I really hope the public listed equities are down 15 to 20%. You're never going to hear them say that. Although for Fund 2, that would be a good backdrop for me to invest into. So I think that's partly why people are investing in my fund as well, because they recognize that we are late cycle. You do need to be thoughtful about how you're actually investing now within an asset class. I also think that what we'll see next year is potentially a little more interest around credit exposure to these companies, just to have obviously a slightly different payoff profile, but where you have some real downside protection, and you're not seeking multiples on capital within 2 to 3 years. You might be seeking 20%, 18% return rather than 35% IRR. So look, we're in for some interesting times.
Yeah, I think as long as you believe in the underlying businesses, to your point, that the timeline, the IRR is kind of what gets tweaked and pulled. But as long as the underlying asset is sound, that's a little bit less of a worry. But it's a good point. So, and I appreciate your commentary around volatility. I'll have to let you know if anybody else has a similar sentiment, but it certainly makes sense. And looking at the fund in itself, you're talking about Fund 2. Where do you focus? Is there an industry focus you look at? I know it's growth stage, really C and beyond, all the way up to pre IPO. But are there really any industries or KPIs you look very closely at?
Yeah, we try not to be too formal with these things, but within the sectors themselves, it's healthcare, cybersecurity, fintech, and data. So they're the 4 sectors that we spend our time in. Then it's really we're certainly not doing C and A, that's for sure. If we did a B, it would be very small. Typically, it's going to be a Series C to a pre IPO situation. And I suppose as it relates to portfolio construction, we do run the fund quite diversified, and that plays into the co-invest, because we partner with our investors a little more, I would say, than most GPs. And so from my perspective, I would rather run things a little more diversified, knowing that given our co-investment model, LPs will be concentrating risk where they want it, rather than me doing that on my own. So I'm a little bit more collaborative, I would say, than most GPs, and I think that's the way the world's going. I think if you look at the way things are trending, it is towards more of a bespoke menu type situation where people want to pick and choose. They want to have, a view. They might have staff at the family office, etc. So they're viewing managers more now as a partner and an access point than they are necessarily viewing them always as you're the smartest, you know how to do everything. We're just going to give you money and we'll see you in 7 years. It's what it used to be. It's not really what it is in the future. And I think some of these large managers are going to wake up to that.
Yeah, the changing dynamic of LPs is a very real thing. And one of the real theses behind what we're doing here at Bear, it's a very different target of who our LP base is, but we see that sentiment across the board, both from individuals and retail investors all the way through institutional. And the co-invest program, which you've mentioned a few times, is really an important piece of it all. For those that might not be familiar with what a co-invest program is, can you just quickly go over what that really means to an investor?
So a co-investment is basically we source an opportunity, whether it's an investment in a primary round or a secondary. Let's make one up. $50 million available to Goanna to invest in a Series E primary. The fund might need 15. So there's 35 million left. So what we do is we set up a Goanna managed Delaware LLC just to buy the 35 million that's left. We turn around to our LP base and we share our investment memo and offer calls. And we talk through the thesis, why the fund's investing, and that we have a co-investment vehicle that they can opt into at their discretion and invest in if they like the investment opportunity. They can pass, they don't have to do any, they can do some. It allows them to right size the opportunity for them, for their portfolio. And a lot of the time, LPs now like certain sectors or like certain companies. So they want to see that and they want to be involved, and some of my LPs even want to dig in and kind of help with the diligence and form a view with me. A lot of my LPs are a lot smarter than I am, so I appreciate that. So it's just part of the collaborative approach now, where more investors want input into the underlying exposure.
That certainly makes sense. And I think where you were going with that is that a lot of LPs want enhanced exposure to either certain sectors or companies within the portfolio, and it is completely optional. Even at Bear, we've got probably a third of the portfolio, which there's additional access to our LPs by way of SPVs. And for folks that invest in funds, we always love to see selfishly as a fund of funds access some of these best directs within the portfolios that we work with. And so we certainly welcome and thank you for sharing that. Rob, it's an interesting space. I think you came from a great, well-known, successful fund. You saw, a space in the market where there might be a gap in the current processes, and you saw the idea between mixing primaries and secondaries as a true differentiator, and then got a ton of access, and then had another differentiator where you offered that access to your LPs. And so I certainly applaud you on all you've accomplished so far at Goanna. One of the things that I also like to end with before I let you go is looking forward, not just into Fund 2 but beyond. Where do you see Goanna, and where do you want to take it? What do you want to see come out of the fund, and what's your vision for this really?
Vision for the fund or Goanna broadly?
For Goanna more broadly. Got
it. So more broadly, and I would like to say I'm still a relatively young guy at 34. I have a decent runway ahead of me. So more broadly, when I think about yield curve control, general interest rate suppression, need for yield, mismatch of assets and liabilities, et cetera, that exist across all investor types, across most regions of the world. I think that investors will continually allocate more capital to private assets, private markets, and alternatives in that hunt. And I think that within that, they will allocate increasingly to, let's call them subscale strategies that take advantage of persistent inefficiencies driven by opaque, fragmented market structures. So you might say the secondaries within private technology is an example of that, which it is. I could give you 5 more examples of that outside of this particular asset class. There's aspects of within energy, there's aspects within litigation financing, within private credit, and even within real estate. So longer term, I think that Goanna will be a multi-strategy investment management firm focused on private markets, taking advantage of persistent inefficiencies driven by fragmented, opaque market structures. That is a solution where LPs can diligence the platform, the compliance, back office, operations, broader investment staff across the business, and come to Goanna and get exposure to a range of strategies that should be differentiated, relatively uncorrelated, and over time potentially invest in a feeder fund going across the platform, or simply investing in particular strategies. So said another way, I'm not trying to compete with some of the big boys, but I'm certainly going to take some of their LPs.
It sounds like a plan, and it's an exciting vision where, you know, a lot of folks don't necessarily have the expertise in every asset class. You know, venture for many is still a very foreign subject, but to build the trust and the brand through, you know, this first leg, which is, you know, what's called growth stage venture capital, and then to expand into other areas where, you know, people at the end of the day are seeking yield. And so for you to be a one-stop shop for them to do that and diversify even beyond just venture, but into other asset classes is certainly quite exciting. And it's something I plan to keep my eye on personally as well. So I appreciate you sharing that with us, Rob, and it's certainly an exciting vision, which I actually didn't even know of. But that's certainly great to hear. Well, I appreciate you being on the show today and sharing a bit about the fund and the market and your vision. You know, it's always great to have a diversity of folks here, and you know, we've talked to everybody from, you know, debt investors to early stage investors, but you know, it's great to have someone that truly understands the growth stage market and, you know, secondaries on top of that. So I appreciate you being on, and you know, for those of you listening, please do follow Bear Ventures on LinkedIn. Follow myself on LinkedIn as well. And also you can check out www.bearvc.com to stay afloat of new episodes that air. Until next time, thank you.